His short-term forecast for Brent, 115 a barrel. But what's the upside, Damien? How high could we go?
Guy, I think the key here is that the upside is actually significant. In normal times, the oil market has three buffers. We have inventories, we have supply elasticity, and demand elasticity. We have no buffer in terms of inventories left. And what shale producers have just told us once again is the elasticity is quite small. So we're down to the last buffer, which is demand destruction. And it's one that requires big price moves, right? So if you look at the move from 100 to 115 that we've seen over 1 week, that on our mapping would be pretty much a 1 month disruption to Russian flows. But those flows are enormous, right? They're 5% of the entire oil market in terms of what goes on a boat out of Russia. So if that persists for 3 months, now we're talking $150 oil prices, right? And I think that's really the core of where we stand in the oil market today. No buffers outside of demand destruction. The potential upside as a result becomes significant.
Well, Damien, there's calls for even further than 150. I think we have 185 in some shops that they're looking at. Let's talk about what can actually make up some of the Russian supply. We see a little bit of an OPEC resistance to amp up their supply more than the $400,000 a barrel. So is the only option here coming down to shale producers? What do you think?
Yeah, let's break it down, right? So, Saudi, UAE on paper have capacity to do more. And realistically, if we look at what they've done in recent years, could perhaps add 1.5 million. It has to be a unanimous decision within OPEC Plus, of which Russia is a member, Iran is a member. So, that's not an easy decision, but conceptually that's there. Iran potentially coming back online, 500,000 initially, 1 million over a year. So that's already 2, if you want, million barrels per day. Shale doesn't respond instantaneously, right? Despite being its short cycle, it needs the cash flow to spend. You have bottlenecks on services, the same labor issues that we see everywhere else in the US. So maybe that's 1 million over another year, right? So that's 2 maybe in the next few months, 3 potentially over a year, year and a half. That can help. But again, Russia puts 5 million barrels per day on boats. So we do need to see a normalization, a recovery, at least in flows. Second, if you bring that supply online, okay, you can match the lost molecules, but you have nothing left, right? That's the core point. The oil market is inherently volatile. Yesterday we lost some Libya output. Over the weekend, we lost some Iraq output. If you're bringing all those barrels, there is nothing left, right? So it is still bullish, even if you can find the supply to meet consumption needs.
It sounds like you're saying that there's really very little buffer in terms of where else you can get the supply, if not for the Middle East, even if you do get those barrels at a lag. Talk to us a little bit about when they would perhaps have to pull out the more extreme option, which of course is the Saudi spare capacity in particular. My understanding is that if that is a level that's ever breached, you start to see the oil market panic even further. But is this a situation that might justify that?
Potentially, again, it goes back to, the enormity of the flows that come out of Russia. So, if those are persistently disrupted to some extent, then it creates a significant call on that spare capacity. And, we know, like we look at April 2020, we know Saudi Arabia, UAE, those core OPEC producers can flex production. But as you said, the flip side of that is then there is really nothing left.